Breaking news, Microsoft is set to retire Internet Explorer on June 15th. That's a little throwback to years ago. Kind of crazy. Not really breaking news, but wanted to point that out to you guys. The US 10-year yield rises 20 basis points to 3.35%, the highest in 11 years. Now that is breaking news. And what is that? Now, I don't know if you guys are familiar with how lending actually works. When you go to buy a house, you go to buy a car, you go to get a line of credit, whatever it is, people use the US 10-year yield as something to be reflective of. And what I mean by that, if the 10-year yield is say 0.5% like it was during 2020, well, investors, they don't want 0.5%. They don't want to get a 0.5% yield. That's why you get mortgage rates that are 2 to 3%, because they're willing to lend you money for a lower rate because they can't get a yield from the government even close to that. Well, when the 10-year yield is now at its highest level in 11 years, that means all of your lending products are going to be much, much more expensive. And businesses, right? If they need to get credit, if they need to get money lent to them, it's going to be very, very expensive. And you're seeing a massive jump today. That's why the markets are down substantially. And we're going to talk about all of this information. We are going to go over AMC. I do want to talk about Redbox briefly, but look at these numbers, guys. The Russell 2000 down 4%, NASDAQ down almost 4%, S&P down 3.15%, and the Dow Jones Industrial Average down 2.24%. At the same time, the VIX is up 18.88%. We still do have a little bit of time left, so these numbers could change by the time you guys see them, but it's not good. It's not a good day. And what is really happening today is nothing specific. It all comes down to Friday, and that CPI report we got really spooked investors, because investors started to buy stocks again, and we have seen a little bear market rally of, it was about 10%. Obviously not anymore. We've lost that plus some. But we did see about a 10% bear market rally because investors were expecting that the Fed in September would stop or slow down raising rates. And then we got blindsided by another higher CPI report showing that inflation has not peaked yet, and now inflation expectations are going up, which will lead to higher inflation in the future. And that is supporting the Fed not stopping raising rates in September. It's supporting the Fed giving us larger rate hikes for a longer amount of time. And at the same time, you got bad economic GDP numbers out of the UK today, suggesting they are going into a recession. And we're getting bad economic numbers. You're starting to see multiple different companies almost on a daily basis reporting that they are laying off thousands of workers, or in Tesla's case, 10% of their workers. There's multiple companies today saying they were, even BlockFi, releasing 20% of their headcount, they called it, their workers. You're seeing this back to back to back. And with the price of energy the way it is, with the consumer the way they are, taking on even more debt, and with much lower saving rates, you're heading into a recession. At the same time, CPI is very high, federal funds rate is very low. The question is, and what the markets are going to start being fearful of, is how much will the Fed have to raise rates once we go into a recession? Typically, the Fed does not raise rates when you go into a recession. Typically, the Fed cuts rates when you go into a recession. There's only really one time in history where the Fed was actually raising rates when we were in a recession. Well, 2 points in time. Right here in 1974, as well as right here in 1980. Both of these times was due to inflation being super high. And what happened? Well, you had really bad recessions, right? You had a recession that lasted almost a full year right here in 1974. And then you did also have a really bad recession in 1980, and then an even worse recession that lasted multiple years from 1981 through almost 1983. So this is not giving the markets good vibes at all, and for good reason. Now, we do have some data that comes out tomorrow, and then we do have the Fed that raises rates on Wednesday and will give us their economic projections going ahead into the future, and that will give us more to go off of to kind of try to judge what the Fed's going to do throughout the remainder of 2022, possibly even into 2023, and it is going to move around the rate hike expectations for better or for worse, and what our end terminal rate is going to be. Now, the terminal rate is where the Fed wants to get to essentially stop raising rates. People thought it was going to be 2% heading into 2022. Now people are starting to say 2.5%, or at least they were a couple months ago. Now they're starting to say 3 to 4%. And if the data does not improve and inflation doesn't start to go down, that terminal rate's going to get a lot higher. And now, what are we expecting by June 14, 2023? Well, we're expecting a terminal rate, hopefully a terminal rate by then, of 4 to 4.25%. And that's up there, right? And that's what you're expecting by July as well. So that's what it looks like the terminal rate is expected to be. Still very low historically, but where the markets are right now, not a lot of companies are in a really, good situation or even a decent situation at all to be able to grow their businesses with lending cost that high. If the federal funds rate is 4%, your 10-year treasury is going to be very, very high as well. I mean, you're up 20 basis points today alone. This is the equivalent of almost a normal rate hike and tightening that we have seen alone today. But you're going to have a basically treasury rate of at least 4 to 5%, like you've seen during 2006, 2007, possibly much higher than that though. So that's not going to be good. That's not going to be good for a lot of companies. It's going to slow down demand. It's going to push us into a recession. And that's the question. How much demand destruction do we get? And how long does inflation actually last? And it's not looking so good. If you guys did not see the video that I did put out earlier, essentially the inflation expectation for next year is now at 6.6%, much higher than where the Fed wants inflation to be. And why that is so important is because if you think about it logically, business owners, when they hear inflation is going to be high for years, when they hear, 6.6% inflation is expected, what do you think these business owners are going to do? They're going to raise prices just because they can. Maybe their costs are going up, sure, but even if they're not, people expect higher prices. They're not going to stop buying your product because you had to raise prices, because after all, everyone's raising prices. Look at the price of fuel. Look at the price of food, right? People expect prices to go up, and that's very unfortunate. And that's why the Fed needs to keep inflation expectations grounded. And we're seeing the highest expectations for inflation of 2022 that we have seen in a very long time. So it won't surprise me to see, the Fed come out and make some crazy statement like a 1% rate hike or, really shock and awe the markets, which is something they have not really wanted to do as of yet. But it might catch the markets off guard. So keep that in mind. Now, Morgan Stanley's CEO, James Gorman, sees 50-50 odds of a recession ahead. It's possible we go into recession. Obviously, probably 50-50 odds now, Gorman said Monday at a financial conference held by his New York-based bank. That's up from his earlier 30% recession risk estimate, said Gorman. Quote, I don't think we're falling into some massive hole over the next few years. I think eventually the Fed will get a hold of inflation, he added. It's going to be bumpy. People's 401k plans are going to be down this year. Still, the Fed waited too long to raise rates, which gives them less room to maneuver should a recession begin, Gorman said. The CEO began discussing the risk of a recession with his international committees last August and September when it was clear that inflation was going to be more persistent than hoped, he said. So I think that boils it down, and I think we actually have like 100% chance of going into recession. But the markets, maybe they're stuck on 50-50. If that's the case, then you're in for a lot more pain potentially to the downside. Now let's go over AMC stock. Let's go over Redbox, because I know some people are going to be really curious on what is happening with that whole situation. And if we look at the short interest of free float for AMC, 22.46%. Current shares that are sold short of 115.78 million. Cost bar max of 25.55%. Cost bar average of 19.18%. Cost bar minimum of 13.87%. 100% utilization. Days to cover at 3.66. Shares out on loan 190 million. Free flow out on loan about 37%. So if we look at the option activity, about 6% positive order value for the day. 12.50 June 17th call coming through for about 68,000. June 24th $12 call coming through for about 37,000. But other than that, all of the activity for the day has been bearish, and some of these orders are very large. $450,000 order right there, $419,000 order right there, $509,000 order right there. All of those are puts, so it's definitely applying a lot of pressure potentially to the downside. So that is that. Now, I do want to point out the economic data that does come out tomorrow is going to be PPI, and that will be very important. That's something the Fed likes to look at a lot. That's producer price inflation, core PPI as well. You know, if your business has a lot of inflation, then you got to pass that cost on to some degree or another. So that will be important as well. And then you do have retail sales 7:30 in the morning that do come out on Wednesday, right ahead of the Fed interest rate decision, which is at 2 p.m. Eastern Standard Time, as well as the FOMC economic projections at 2 p.m. as well. You get the dot plot, you get the Fed statement, and then you get the press conference from Fed Jerome Powell at 2:30 p.m. And that's going to be the thing that really does move the markets. Keep in mind what happened last time. Off the initial report at 2 p.m., the markets fell about 1%, and then what inevitably happened by the end of the day after Fed Jerome Powell came out, said they're not thinking about a 75 basis point rate hike. Well, the markets closed up about 3%, and then the next day the markets fell 4%. That's something I will never forget. The flip-flop in the markets was insane, and that is something that could happen again. And it could be, you know, very similar, or it could be even more extreme of a flip-flop. It's really hard to tell, and I obviously can't project that to you guys, but it does look like tomorrow could be a little bit more downside heading into that essentially press conference with Fed Jerome Powell. Obviously, as you guys already know, we're primed for a gamma squeeze if we do get a bullish reaction in the markets. About 3,600 calls that are in the money for this week, 351,000 that are out of the money for this week. In the money puts at 133,000, out of the money puts at about 80,000. So a lot of potential buying power on the option chain. But AMC for the day, I mean, you're down about 8.17%, sitting at $11.41 per share. We're still in this range, really in between $10 and $16. We've been in this range for the past over a month now, and the volume is very low for the day, only about 23.7 million. The RSI getting extremely oversold, and the MACD is now turning bearish. I've said it and I'll say it again. 50 and 100-day moving averages are your friend. You want to watch them. If we can break out above them, then that's where you could get the the move back up to the 200-day moving average, like we've seen picture perfectly back here in March. So that is going to be all for this video. Hit the like button, subscribe to the channel, source those comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and I will see you in the next one.